Welcome to Editorial Volume 01, where we dive into the law of business and business organizations. Today, we'll explore the essential relationship between entrepreneurship and business law. Our focus will be on how legal structures, liability concerns, and regulatory frameworks impact every entrepreneurial venture. These foundations are crucial for anyone looking to start or grow a business, as understanding them helps entrepreneurs navigate risks and make informed decisions. Let's begin by unpacking the key concepts that shape the legal landscape for entrepreneurs. Entrepreneurship is fundamentally about creating value by taking risks, having a clear vision, and taking decisive action. It involves spotting opportunities that others might overlook, those unmet needs in the market. Once you identify an opportunity, the next step is organization, transforming your ideas into a structured business with the right resources in place. But it's important to remember that entrepreneurship inherently involves risk. This means accepting responsibility not just for the outcomes, but also for the financial, legal, and market challenges that come your way. At its core, entrepreneurship is a dynamic process that balances these key elements: opportunity, organization, and risk to pursue profit and growth. Here, we focus on what it truly means to be an entrepreneur. It's more than just starting a business. It's about turning ideas into a fully functioning enterprise. An entrepreneur doesn't just have a vision. They organize that vision, manage risk, and take responsibility within a legal business framework. The process involves three key actions: creating, building, and protecting. Creating means spotting opportunities that others might miss. Building is about assembling the necessary capital and people to bring the idea to life. Protecting involves choosing the right business structure and managing risks effectively. Overall, an entrepreneur combines vision, execution, and accountability to make the venture succeed. When we're looking at different business structures, it's important to understand how each balances ownership, liability, taxation, and legal formalities. First up, a sole proprietorship is owned by one individual. It's the simplest to start but comes with unlimited personal liability, meaning your personal assets are at risk if the business runs into trouble. Next, we have partnerships, which involve two or more partners. Liability is often shared personally among the partners, and control is usually governed by an agreement between them. This setup allows for shared responsibility, but also shared risks. Then there's the LLC, or limited liability company. This structure protects your personal assets and offers flexible taxation options, often allowing income to pass through directly to your personal tax return. That's why it's especially popular with small ventures looking for a balance of protection and simplicity. Finally, corporations stand as separate legal entities. They provide strong protection for owners against personal liability, but are subject to the most regulation and formalities. Choosing the right structure requires intentional consideration of your business goals and risk tolerance. Each form serves different needs, so selecting with intent is key. Let's focus on the sole proprietorship structure. This type of business is owned and controlled entirely by one person, giving them full authority over all decisions. However, the owner and the business are legally considered the same entity, which means the owner is personally liable for all business debts and obligations. When it comes to taxes, any profits or losses from the business are reported directly on the owner's personal tax return, simplifying the process. This structure is very simple to establish, making it a popular choice for new entrepreneurs, but it also carries the highest level of personal financial exposure. So, while easy to start, it's important to understand the risks involved. When we talk about a partnership, it means two or more owners come together to combine their skills and capital. This setup allows them to share management duties, profits, and also the legal responsibilities. One of the biggest advantages is how easy it is to form a partnership compared to other business structures. You also benefit from shared capital and expertise, which can really help the business grow. Another key benefit is pass-through taxation, which means the business itself isn't taxed separately. Profits and losses pass directly to the partner's personal tax returns. On the flip side, there are some important disadvantages to consider. For example, partners have joint personal liability, meaning each partner can be held personally responsible for the debts and obligations of the business. This can be risky because any partner might make decisions that legally bind the whole business. Profit-sharing conflicts can also arise if partners disagree on how earnings should be divided. That's why clear agreements matter the most in partnerships. To ensure everyone is on the same page about responsibilities, profit distribution, and management roles. Having these agreements in place helps prevent misunderstandings and protects all partners involved. When we talk about the limited liability company, or LLC, it's important to understand why this business structure is so widely chosen, especially for small ventures. An LLC offers personal liability protection, which means that as an owner, your personal assets are generally shielded from business debts and legal claims. This is a key advantage that separates it from sole proprietorships or partnerships. Another major benefit is the flexible tax options available. LLCs can choose how they want to be taxed, whether as a sole proprietorship, partnership, or corporation, which can provide significant financial advantages depending on the situation. In addition to tax flexibility, LLCs have a simple operational structure. Compared to corporations, they require less ongoing paperwork and formalities, making it easier to manage on a day-to-day basis. This simplicity doesn't mean less protection or professionalism. Rather, it streamlines business administration. All these factors combined, liability protection, tax flexibility, simple operations, and reduced paperwork, make the LLC especially popular among small business owners who want solid protection without unnecessary complications. Here we're looking at the corporation as a legal entity. When a business incorporates, it essentially creates a separate legal person. This happens through state filing, adopting bylaws, and issuing stock. This separation is crucial because it means the corporation can own property, enter contracts, and be liable independently from its shareholders. Governance within a corporation is managed by the board of directors. The shareholders, who are the owners of the corporation, elect this board. The board then appoints the management team responsible for day-to-day operations. This structured control ensures a clear division between ownership, oversight, and management. This separation of entity and structured control is what defines the corporate form, giving it legal recognition and a framework for operation and accountability. When it comes to setting up your business legally, getting the registration and formation right from the start is crucial. First, you need to choose the appropriate legal structure for your business. This decision affects everything from taxes to liability, so it's important to pick the right one. Next, you'll register your business name to make sure it's unique and officially recognized. After that, filing the state formation documents is a necessary step to legally establish your business entity. Finally, don't forget to obtain your tax identification number, along with any licenses and permits required for your industry and location. Taking these steps properly on day one ensures a solid legal foundation before you launch your business. When it comes to business structures, one of the most crucial decisions you make is how personal liability and legal protection are handled. Essentially, the structure you choose determines if business risks stay within the company or if they can affect your personal assets. In the first scenario, where there is unlimited liability, the owner and the business are considered one and the same. This means debts and lawsuits can directly impact your personal belongings, like your home, savings, or personal income. This setup is common in sole proprietorships and general partnerships, where there are few legal barriers separating personal and business obligations. On the other hand, in the second scenario, with limited liability, the business is treated as a separate legal entity. Here, personal assets are generally shielded from business risks. This is typical for corporations and most LLCs, where the owner's risk is usually limited to the amount they've invested in the company. However, this protection is most effective when all legal formalities are properly observed. So when comparing these two, liability essentially defines your entrepreneurial risk. Understanding this difference is vital to protecting yourself and making informed decisions about your business structure. When choosing the legal structure for your business, it's important to understand how it affects taxation and profit distribution. For sole proprietors, business income is reported directly on your personal tax return. You pay taxes once on the profits, but you're also responsible for the full 15.3% self-employment tax. However, ordinary business expenses can help reduce your taxable income. In partnerships, we have a shared pass-through model. The partnership itself files an informational return, but it doesn't pay income tax. Instead, each partner reports their share of profits or losses on their personal returns, typically documented through a K-1 form. Active partners might also owe self-employment tax on their earnings. Corporations face entity-level taxation. For C corporations, profits are taxed at a flat federal rate of 21%. The downside is that dividends distributed to shareholders may be taxed again, leading to double taxation. However, some corporations can elect to be an S corporation, allowing profits to pass through to shareholders without corporate-level tax, similar to partnerships. Ultimately, the business structure you select will shape how much after-tax profit you keep, so it's crucial to consider these tax implications carefully. When we talk about protection creating value, we're really focusing on how intellectual property rights serve as core legal assets for entrepreneurs. These rights safeguard the unique ideas, identities, expressions, and know-how that give any business its competitive advantage. There are 4 fundamental types of intellectual property protection entrepreneurs should understand. First, patents protect inventions and innovations, giving inventors exclusive rights for a period of time. Second, trademarks secure brand identity by protecting logos, names, and other symbols that distinguish products or services. Third, copyrights protect original works of authorship, like writings, music, and art. Last, trade secrets cover confidential business information that provides an edge in the market. By leveraging these protections, businesses strengthen their position and add tangible value to their ventures. When we talk about contracts and agreements, it's really about establishing legal clarity. Every serious business relies on clear and enforceable terms to operate smoothly and avoid misunderstandings. This means putting everything in writing is crucial. First, employment agreements set clear expectations between the company and its employees, protecting both parties. Then, vendor contracts ensure that the terms of delivery, payment, and quality are explicitly agreed upon. Customer agreements clarify the services or products provided and the obligations of both sides, helping build trust. Finally, partnership agreements define the roles, responsibilities, and profit sharing among business partners, which is essential for a successful collaboration. By having these agreements properly documented, businesses can prevent disputes and create a solid foundation for growth. So, the key takeaway here is, always put it in writing to safeguard your business interests. Before you open your doors, it's crucial to ensure your business is fully compliant with all legal requirements in the locations and industries where you intend to operate. This starts with core filings, such as state registration and obtaining your tax ID, which officially recognize your business and allow you to meet tax obligations. Next, you'll need to secure local approval, which involves getting the appropriate business license, zoning clearance, and occupancy permits to make sure your physical location meets local regulations. On top of that, industry-specific permits are often required, including health permits, sales tax certificates, and professional licenses depending on your field. Remember, these permits can vary widely by state, city, and industry, so it's important to research and comply with all relevant rules to avoid any operational setbacks. When a business starts hiring employees, the legal responsibilities go well beyond just growing the company. It's crucial to understand and comply with fair employment practices as well as operational regulations. First, during hiring, employers must follow lawful recruiting methods, properly classify workers, and adhere to anti-discrimination laws to ensure fairness. Next is payroll, which involves managing wages, tax withholding, overtime, and maintaining accurate records in compliance with the law. Then there are benefits, including managing leave policies, insurance, and any mandated benefit plans, which help support employee well-being and legal compliance. Lastly, workplace safety is a major responsibility, requiring employers to provide safe conditions, conduct appropriate training, report incidents, and work actively on injury prevention. These core obligations are foundational for any employer to operate ethically and legally. When we talk about the law of business and business organizations, understanding the different types of insurance coverage is crucial for protecting the company. First, there's general liability insurance, which covers basic risks like bodily injury or property damage that could occur during business operations. Then, we have professional liability insurance, which is essential for protecting against claims related to errors or negligence in the services provided. Workers' compensation is another key coverage, ensuring that employees are protected if they get injured on the job. Property insurance covers damage to physical assets, like buildings and equipment. These types of insurance fit into a larger risk management strategy designed to protect the business from exposures that could interrupt operations or drain financial resources. Importantly, maintaining proper insurance coverage isn't just good practice. It's often a legal requirement and an essential part of compliance. This way, the business stays safeguarded and can continue operating smoothly despite potential risks. When it comes to funding a venture, entrepreneurs have several options, and their choice depends on factors like control, repayment terms, risk, and how quickly they want their business to grow. One common method is bootstrapping, which means self-funding the business using personal savings or early revenue. This approach allows for maximum control, but can limit how fast the business can expand. Another option is bank loans, where entrepreneurs borrow money with set repayment schedules and interest. While this allows them to retain full ownership, it comes with the obligation to repay regardless of business performance. Angel investors provide private capital in exchange for equity and often bring valuable guidance, which can be helpful for early-stage startups. Finally, venture capital is an institutional investment typically aimed at high-growth, scalable startups. It offers substantial funding, but usually requires giving up significant equity and some control. Understanding these options helps entrepreneurs decide the best path for their company's capital needs. When we talk about legal planning in a business plan, it's really about creating a clear roadmap that guides your decisions and protects your venture. A strong business plan isn't just a tool to attract investors. It also thoroughly documents the legal framework that underpins your company. This includes your business structure, the obligations you have, and the risks you face. Starting with the executive summary, we outline the venture's purpose, ownership structure, and mission. These set the foundation for everything that follows. Then, in the market analysis, we consider customer demand, competition, and the regulatory environment, which directly influence legal considerations. Financial projections cover startup costs, the funding you'll need, and cash flow, critical for understanding your legal obligations related to funding and contracts. Operations involve defining roles, establishing contracts, ensuring proper licensing, and maintaining compliance with laws and regulations. Finally, risk assessment is crucial for identifying liability exposure, insurance needs, and contingency plans. Together, these components help transform your idea into a formal, legally structured enterprise, minimizing surprises and setting you up for success. As a business grows, the legal demands it faces also increase significantly. Expansion isn't just about reaching more customers or entering new markets. It actually multiplies the number of legal touchpoints much faster than many founders anticipate. This means that entrepreneurs need to proactively revisit their legal structure, compliance measures, contracts, and risk management before scaling creates vulnerabilities. There are 4 key areas that typically need attention during growth. First, entity upgrades become necessary because the original business structure might no longer be suitable as the company scales. Second, when entering new jurisdictions, it's critical to properly register, qualify, and comply with local laws and regulations. Third, workforce rules get more complex as hiring ramps up, requiring keen attention to employment law. Lastly, contract capacity must keep pace. Stronger agreements with vendors, landlords, and customers become essential to protect the business. In short, Expansion demands a robust legal infrastructure to support and sustain growth effectively. Ignoring this can expose the company to significant risks down the line. When it comes to exit strategies and succession planning, it's crucial to plan the endgame well before you actually exit your business. Entrepreneurs don't just build ventures, they also prepare the smooth handoff that ensures the business continues to thrive. There are 3 lawful paths to achieve continuity. The first path is selling to a buyer. This involves transferring ownership in a way that maximizes value, which requires careful negotiation, thorough due diligence, and clear closing terms. The second path is merging with another company. This approach combines assets and operations, helping to expand scale, reach new markets, or strengthen strategic positioning. Lastly, the third path is passing the business on to the next generation. This path focuses on preserving continuity through a deliberate succession plan, solid governance, and an effective leadership transition. Each of these options requires thoughtful planning to secure the long-term success and legacy of the venture. One common pitfall entrepreneurs face involves small legal mistakes that might seem minor at first, but can quickly turn into costly business problems. The first is commingling funds, mixing personal and business finances, which can create serious complications for liability and taxes. Next, ignoring intellectual property is a big risk. Failing to protect your ideas or brand can lead to lost opportunities or infringement issues. Unclear partnerships are another frequent issue. Without clearly defined roles and agreements, disputes can arise that threaten the business. Inadequate documentation also puts entrepreneurs at risk, as lacking proper contracts or records can weaken your position in legal matters. Lastly, skipping insurance might save money initially, but can expose your business to significant financial loss in the event of unexpected problems. Avoiding these 5 mistakes is crucial to safeguarding your venture and minimizing avoidable risks. Here we see a case study that highlights how a business evolves from a startup to an established company, focusing specifically on changes in its legal structure. Initially, the business begins as a sole proprietorship, which is straightforward and allows for complete personal control, ideal for the very start. As the company grows and risks increase, it adopts an LLC structure. This provides a liability shield, protecting personal assets while supporting a larger operation. Finally, when the business aims to scale further and attract investors, it transitions into a corporation. This structure is designed to accommodate expansion and investment opportunities, making it suitable for an established and growing enterprise. Each stage represents a strategic adjustment to meet the changing needs of ownership, risk management, and capital. When we talk about the law and entrepreneurial ethics, it's important to understand that good business goes beyond just following the law. It's about being truly accountable. First, honest dealing is essential. Being truthful in sales, contracts, pricing, and promises helps build trust that is not only lawful but also sustainable. Next is regulatory compliance. Meeting legal requirements is the baseline. It's the minimum standard every responsible business must uphold. Then there's environmental responsibility. Entrepreneurs need to think carefully about the impact their business leaves on the environment, making sure their operations are sustainable and mindful of the future. And finally, fair competition is crucial. Success should come from offering value and innovation, not from deception or practices that unfairly limit competition. Ethics in many ways give law its real purpose. They guide us to do what's right, not just what's legal. When starting a business, having the right resources can make all the difference in avoiding costly mistakes and building on a solid foundation. First, government agencies like the Small Business Administration, state filing offices, and licensing bodies provide essential support and information to help you comply with legal requirements. Secondly, professional services, such as lawyers, accountants, and tax advisors offer specialized expertise that protects your business and ensures financial health. Industry associations and chambers of commerce are valuable trade resources that connect you with networks and market insights, giving you a competitive edge. Online platforms also play a crucial role, offering templates, research tools, and educational materials that help you learn and plan effectively. Finally, business mentors, including incubators, accelerators, and experienced founders provide personalized guidance, sharing their knowledge and experience to help you navigate challenges. Together, these resources create a strong support system where entrepreneurs can build their ventures with confidence and clarity rather than guesswork. When it comes to the law of business and business organizations, there are 5 essential principles I want you to keep in mind. First, choose your business structure wisely, because the right setup can protect you and create opportunities. Second, always protect yourself legally, which means understanding your liabilities and ensuring you have the right protections in place. Third, document everything. Clear records and contracts are your best defense in any situation. Fourth, stay compliant with laws and regulations to avoid penalties and keep your business running smoothly. Finally, plan for growth. Think ahead about how your business can evolve and what legal and organizational changes you might need. These principles are crucial foundations to carry forward as you build and sustain your business. As we conclude, I want to leave you with this key thought. Entrepreneurship truly begins with informed action. Your journey starts right here, right now. Build boldly. Don't hesitate to pursue your vision with confidence. And equally important, protect that vision by establishing the right legal foundation. Understanding the laws of business and business organizations will be crucial as you move forward. So, take what you've learned and use it to create something impactful and sustainable. This is just the beginning.